I'm going to talk about the financial crisis of 2008-2009, and I'm going to take a Austrian school perspective. This is a talk that I've given on several occasions, and the version I'm doing now was written essentially in August 2012. It's been some time since I've given this talk, and I think that's a reflection of the fact that times have moved on and people are now more interested in other topics, and so other talks seem to be more popular. But whilst I've got the notes in front of me, I thought that I'd record a YouTube version. It's now May 2016, and I wanted to have a version of this talk that I can put on my website alongside some other resources on the financial crisis. So you can see the URL at the bottom of the screen. There's several recommended books, policy papers, and other videos. Together, I think they provide a useful understanding of what happened 2008-2009. The key topics that I'm going to address are what was the 2008-2009 financial crisis. I'll talk about how it ties into a theory of boom bust cycles, and this is the Austrian school component. We'll talk about Austrian business cycle theory. And then third, what the implications are for sovereign debt crises. Why this isn't just a kind of one-off event, but why it ties in with some underlying trends and some underlying problems in Western economies. So firstly, what happened? Well, one place to start is the evolution of the mortgage market, and we can focus on the US here. Traditionally, mortgages relied on primary markets. So this is a direct financial agreement between the borrowers, i.e. homeowners, and the lenders, i.e. banks and building societies. Since the 1970s, there's been a rise in secondary markets. This is where the loans, i.e. the future income stream, is sold to third parties. Now, this is probably a good thing. It creates a more liquid market. But it leads us to securitization. This is by bundling mortgages into a pool, you can reduce your exposure to individual defaults. So you take all of the mortgage payments from several different mortgage companies and put them into a pool. This is where we can bring in complex quantitative techniques that split up these securitized assets into different tranches. This then allows you to be able to sell those tranches to people with different risk profiles. What you've done here is created a collateralized debt obligation, i.e. a CDO. Now the buyer of the first tranche gets first claims on the cash flow. The second tranche will get whatever's left over, and so on. Because of this, we might rate the first tranche AAA, and the second and third tranches far lower because they're less likely to get the remnants of the cash flow. As Brummer has said, these aren't prime cuts of meat, but people thought there was enough quality to constitute decent enough sausages. Now, this is a very simplified version of how securitization works. A longer version is in this excellent video by Jonathan Jarvis called The Crisis of Credit Visualized, and I recommend you take a look at this. But then once you've got this evolution of the mortgage market, you've also got a politicization of the mortgage market. Now, home ownership has been a very large policy goal for successive US presidents, especially Bill Clinton and then also George W. Bush, especially for people on low incomes or bad credit histories, i.e. people where commercial banks were reluctant to lend to. This is what we refer to as subprime. Fannie Mae and Freddie Mac were created in 1938 and 1970 to purchase and securitize mortgages on the secondary market. Now we can explain these two terms when we say they purchase and securitize. They purchase in the sense that they provide a market for subprime mortgages so that banks are willing to supply them. They securitize them because they pioneered quantitative techniques to manage risk. Fannie and Freddie are what are known as government-sponsored enterprises, i.e. GSEs. Although they are run for profit and publicly traded, they are also implicitly underwritten by the government, and therefore they're viewed by markets as essentially being as safe as US Treasury bonds. We can also talk about the ratings agencies, for example Moody's, Standard & Poor's, and Fitch. Now they have two types of legal mandate. Firstly, there's barriers to entry for bidding competition. Only those three ratings agencies were deemed what are known as nationally recognized statistical ratings organizations. This was actually axed in 2006. So then there are now 10 ratings agencies that have this status. The other legal mandate that supported these ratings agencies were regulations that prevented institutional investors buying securities that were below a certain rating. The issuer pays model meant that banks could shop around for whichever ratings agency was most favourable. They were required by law to have one of these ratings agencies. There was no competition among different ratings agencies. And the issuer pays meant that they could basically find out which one was willing to provide them with the certification that they required. The ratings agencies became involved in actually creating these securities. In other words, they were advising on what banks would need to do in order to receive a certain rating. The outcome of this is you essentially have a cartel that is free from market pressure. According to Jeffrey Friedman, Moody's hadn't updated its basic statistical assumptions about the US mortgage market since 2002. In 1999, that US Housing Secretary declared that Fannie and Freddie should help poor people get mortgages. Government created targets for what percentage of mortgages should go to low-income and very low-income people. Low income is defined as anybody with income less than the median. In 2004, the target was 42% of mortgages should be less than median. In 2006, it was 50%. In 2008, it was 56%. 56% of mortgages had to go to people on less than median income. In terms of people on very low income, in 2006, the government target was for 20% of mortgages to go to very low income, and for 2008 to be 28%. And this policy worked. In the US, around 70% of housing was only owner-occupied, but mortgage debt was 101% of disposable income. Bill Clinton then mandated that they reduce lending standards, and the Community Reinvestment Act required lenders to better serve minority groups. We can see an example of the growth of subprime when we see that mortgages with no down payment rose from being just 3% of the mortgage market in 2001 to 24% in 2005. Loans with limited documentation rose from 27% in 2001 to 40% in 2005. And mortgages with no down payment and limited documentation rose from 1% in 2001 to 12% in 2005. From 2003 to 2006, the subprime market went from 4% of total mortgages to over 13%. This generated quite a nice business proposition. High street banks basically gave mortgages to people with no money, but then sold those mortgages onto this secondary market. Investment banks charged a fee for securitizing those assets, ratings agencies charged a fee for declaring how risky each tranche was, and government can finally boast of expanding home ownership. Everybody's happy. So, what went wrong? Well, the first thing that went wrong was defaults on those subprime mortgage payments. Banks were happy to lend to customers for two reasons. Firstly, the law of large numbers meant that defaults would tend to be local. Secondly, they figured that if people did default, then they could recoup the losses from the underlying asset, i.e. the house. Historically, high housing prices and the widespread belief that they would continue to rise meant this was a good business proposition. So the trigger for the financial crisis was a fall in asset prices. It was when these house prices stopped rising and began to fall. Instead of seeing a housing ladder, we started to see people on a housing snake. It turns out that the increasing value of the underlying assets was in fact a bubble. This meant that the mortgage-backed securities weren't really being backed. Now, the housing market is the main focal point of the financial crisis, but it's important not to read too much into this. Government policy tends to determine where bubbles appear, but don't necessarily explain their root cause. When we look at the cause of the financial crisis, we can also look at the over-leveraging due to low costs of finance. Rising leverage created easy mortgages and a housing bubble. Lots of borrowing meant high levels of personal and corporate debt. But then the real question should be, where are the banks getting this credit from? We can say that the root cause of the financial crisis was excess money creation by central banks. There was a domestic monetary policy error, which is that central banks were keeping interest rates low, encouraging investment in capital-intensive industry and the purchase of capital-intensive consumer goods such as houses. And we can also see international capital flows where excess savings in Japan and China and East Asia generally were generating a low interest rate environment. We can also look at this in terms of the classic economic distinction between incentive problems and knowledge problems. Some of the incentive problems, one of the most famous ones is many people talk about greedy bankers. I think this is somewhat of a misnomer though. We can think of greed as being a constant. It's like gravity. So whereas gravity is a cause of airline crashes, it's very difficult for us to blame gravity for any airline falling. Gravity is there when airlines fly successfully and when they crash, therefore they're not a very good cause of crashing. According to Darren Acemoglu, the discipline of economics has given us the insight that greed is neither good nor bad in the abstract. When channeled into profit maximizing, competitive and innovative behaviour under the auspices of sound laws and regulations, greed can act as the engine of innovation and economic growth. But when unchecked by the appropriate institutions and regulation, it will degenerate into rent-seeking, corruption and crime. What I'm getting at here is that we need to look at institutional factors, not psychological ones. Greed is a constant. Some of those institutional factors are things such as deposit insurance. Now, this is introduced to prevent bank runs by reassuring depositors that their money is protected. But it's a classic example of moral hazard because any form of insurance reduces the costs of the behaviour it's trying to prevent. It shields banks from one of the worst possible consequences of imprudent risk management. According to some famous economists, it incentivizes banks to take on higher portfolio risk and keep lower reserves than it otherwise would. Another option is the Greenspan put. Now, a put is something that lets you sell shares at a decent price even if they've fallen below it in value. The idea here is that Alan Greenspan, when he was governor of the Federal Reserve, said that we can't identify bubbles, but we can act when they burst. The problem is that investors now know that if there's a recession, the Fed will slash interest rates and help them out. So if they need to liquidate, they can do so at stable prices. Some examples of this were the 1987 stock market crash, Gulf War, the Mexican crisis, the Asian crisis, the long-term capital management crisis, which was a hedge fund rescued by other banks under the supervision of the Fed. There was the dot-com bubble, there was 9/11. All of these occasions, the Fed stepped in and aggressively lent money and gave investors the belief that when the economy turns, the Federal Reserve would bail them out. We can also talk about specific bailouts. The problem with bailouts is that they privatize gains and socialize losses. It basically means that if investors are in a regime where prices rise, they get to keep all of their winnings, but if prices fall, then they'll be bailed out. This is a strong incentive to take on too much risk. In addition to incentive problems, we can also think about some knowledge problems. One of them was low interest rates. So banks saw low interest rates and thought that they should invest, even though there wasn't enough real wealth in the economy to fund these projects. According to John Taylor, a housing boom followed by a bust led to defaults, the implosion of mortgages and mortgage-related securities at financial institutions, and resulting financial turmoil. Monetary excesses were the main cause of the boom. The Fed held its target interest rate, especially in 2003 to 2005, well below known monetary guidelines that say what good policy should be based on historical experience. The greater the degree of monetary excess in a country, the larger was the housing boom. Another example of a knowledge problem is inflation targeting. Policymakers weren't concerned by low interest rates because inflation was low, but they were focused on the consumer price index, which ignores factors such as share prices or housing prices. If central bankers were looking at other targets or other measures of inflation, then they would have been more concerned with what was happening with interest rates and the money supply. Another example is regulatory arbitrage. Basel I mandated the amount of capital banks needed to devote to fund various assets. So, for example, according to Jeffrey Friedman, a bank that originated a $100 mortgage, sold it to Fannie or Freddie for securitization, and then bought it back as part of an agency MBS, would reduce the amount of capital it needed to use from $4 to $1.60. This would reduce the bank's need for scarce capital by 60%. In other words, it was possible for banks to try and get round capital controls and other forms of regulation by engaging in this type of activity. Another example is fair value accounting. Banks thought they could model or forecast the underlying values, but the problem with this is that value comes through exchange. Fair value accounting is a system that was mandated by regulators that encouraged auditors to use current market values rather than understand that something is worth only whatever a buyer will pay. So by on their balance sheet including the current market price of various assets, once there was a crisis and the market price of those assets began to fall dramatically, the value of the balance sheet of all of these banks dropped dramatically. This also leads to a vicious circle as companies have to write down the value of their assets depending on current market conditions, and a downturn becomes very problematic for everyone. The last example of a knowledge problem is outsourced judgment. If you think about it, very few people research their banks before giving them their savings. We tend to assume that regulators do that for us, and that makes there's a lower incentive for us to generate oversight for our financial institutions. If you think about Bernie Madoff as an example, he didn't rip off big investment banks because they did due diligence and they were suspicious actually of his fund. What he managed to do though was he managed to rip off individual investors, and those individuals assumed in part that he was legitimate because if he wasn't legitimate, they expected regulators would have picked up on it and made sure that he wouldn't be open for business. Now, another thing to stress is that we shouldn't be too surprised by the financial crisis. According to the IMF, since 1970, there have been 124 systemic banking crises. The major examples are Japan in the 1980s, the European exchange rate mechanism in 1992 to 1993, the crisis in Mexico in 1994, the East Asian financial crisis 97-98, Russia in 98, long-term capital management in 98, Argentina 1999 to 2002, the US dot-com boom in 2000 to 2001, and the current crisis which has been 2007 onwards. And with all these obvious reasons, it's tempting to think that the causes were obvious. It's important to stress though that the causes weren't obvious at the time, and that's why systemic banking crises are very rarely predicted in advance. The main lesson is that we don't know when a crisis is coming, even though we do know that crises tend to be quite common. This is part of the problem with regulation, because if we try and tweak the regulatory regime based on what we've learned this time around, it will be destined to fail because we'll be continually correcting previous crises. Now, there's two alternative narratives to explain the economic crisis. And when you read newspapers, I think you can pick up very clearly on either of these two alternative narratives. The first one is the broken down car. According to this narrative, the economy is like a car where the engine has stalled. If your car has broken down, you need to jump start it. What you need to do is you need to find a mechanic, somebody who understands the motion of the vehicle and understands how they can get the motion of the vehicle working again. There's a fairly mechanistic relationship between policy and economic activity, and as long as you bring in the right expert, they'll be able to fix that problem and get the economy moving again. But I want to contrast this with an alternative, a more Austrian view of the economy, which is the drunk that's sobering up. In this narrative, it's 6 o'clock in the morning, you've been out the night before, you had a very good night, you were very drunk, but now the hangover's starting to kick in, you're feeling bad, it's going to hurt. The Austrian theory of the trade cycle takes this drunk that's sobering up narrative and plays it out. It rests on the claim that artificial credit expansion leads to unsustainable investment projects. In other words, it's impossible to be drunk and to enjoy the euphoria of being drunk indefinitely. At some point, structural imbalances will reveal themselves and you'll be forced into a correction. We can think of the Austrian business cycle theory in four main phases. The first phase is the boon. If the central bank is creating inflation, i.e. printing too much money, they're forcing interest rates artificially low, then the signal being sent to us is to borrow money and invest, even though capital is scarce and we can't all fund our investment projects. Since the interest rate is the signal that provides coordination over time, the manipulation of it can cause these clusters of errors. Easy money and low interest rates encourage firms to borrow money and invest in interest-sensitive, in long-term projects, and for consumers to consume rather than to save for the future. This leads to the economy pulling in two directions at once. The cheap credit is fueling malinvestment. The strong consumer demand leads to overconsumption. We end up having a tug of war over the stock of real resources between the producers and the consumers. Now, this tends to be won by the business sector because they tend to be closer to the source of credit creation, and this would imply that capital-intensive industries are stimulated. This creates a rise in profits, and it creates a stock market boom. Phase 2, though, is the bust. Now, the boom sowed the seeds of the subsequent bust. The inflation actually causes the recession. When shortages become apparent, prices will spike. This is what's known as the Ricardo effect. This becomes a credit crunch, which is why we tend to see commodity price spikes at the onset of a crisis. It's the realization that we don't have enough wealth to warrant our current production plans. The recession is the necessary effort to recalculate those plans. Central banks may increase interest rates to apply the brakes to inflation, and indeed the crisis is felt strongly in the banking sector. Their loan portfolios deteriorate as highly leveraged investment projects prove to be unprofitable. We'd expect banks to call in loans to preserve their balance sheets. Corporations will scramble for funding, and interest rates will jump up since banks are reluctant to lend to each other. This will also lead to a liquidity crisis as companies liquidate their assets and are forced to accept a loss, in other words, a fire sale. Phase 3 is the recession. Now, to Austrians, there are structural imbalances in the economy as a consequence of the misallocation of resources during the boon. Firms will recalculate their investment plans based on the lower growth forecasts. This isn't when inefficiencies are being caused, though. This is when the prior inefficiencies are being revealed. In April 2013, a study found that people waste £50 a month throwing away food. The error, though, isn't buying that food. The error is buying that food, not throwing it away. We can think of throwing it away as being the optimal resource to the initial error of buying it in the first place. Similarly, the recession is the optimal response to previous errors. We can think of good recession policy. So good recession policy might be liquidity provisions for solvent banks at penalty rates. You'd want to avoid a secondary recession, which can come if monetary policy becomes too tight. But that liquidity provision needs to be at a penalty rate. Another example of good recession policy is to allow labour markets to adjust to the new conditions. In other words, to improve incentives for education and training, help labour mobility, help the hiring of low-skilled workers, etc., not block employment opportunities. Another good recession policy is to resist the temptation to simply do something. According to Stefan Oppers, according to Austrians, an economy in recession does not respond well to expansionary monetary or fiscal policies. Bad recession policy to Austrians are things that generate regime uncertainty. So using the crisis as an opportunity to push through vast and arbitrary spending plans undermine private property rights and therefore undermine investors' confidence in the recovery. When Alistair Darling, the UK Chancellor, vowed to take whatever action is necessary, he was intending to help and calm confidence, but by revealing that he was willing to take any action at all, this can actually have the reverse effect of destroying confidence by scaring people. Bad recession policy is also trying to stimulate demand because this is just postponing and indeed aggravating the correction of the previous excesses. If you think that the economy in 2006 was fundamentally unhealthy, i.e. it was booming, then we don't wish to preserve it. Bad recession policy is market interventions that prohibit adjustments in relative prices. We need prices to adjust to the new conditions. As an aside, by the way, it used to be the role of the central bank. According to William McChesney Martin, he said the role of the central bank was to take away the punch bowl just when the party gets interesting. Now it seems that the role of central banks is hair of the dog, which is essentially saying As soon as you start to feel hungover, you need to get drunk again. The difference between the Austrian and the monetarist position is quite important because many people fail to see the difference between what monetarist economists and what Austrian economists might say. Now, there's really two views, and Roger Garrison has put this very well. He said, did the collapse occur, A, in the midst of a period of healthy growth because of sheer ineptness of the central bank, or B, near the end of a policy-induced boom that was unsustainable in any event and in the midst of confusion about just what the problem was and how best to deal with it? Most economists, i.e. monetarists or indeed Keynesian economists, would say option A. They'd say the collapse has come in the middle of a period of healthy growth because of bad central bank action. And the monetarists and the Keynesian economists would then argue about whether monetary policy or fiscal policy would be most effective at restoring aggregate demand. Austrians, though, don't say that the period of growth was healthy. They say that the collapse occurred near the end of a policy-induced boom that was unsustainable in any event. And this puts a completely different light on the problem, because you realise that the goal isn't to get back to what happened immediately prior to the bust, it's to get the economy into a more sustainable pattern. The fourth stage of the boom-bust cycle is the recovery. This is when the capital stock is rebuilt through investment. It's when resources are reallocated to better satisfy customers' pressing needs. It's when you have a healthy foundation for future growth. The problem, though, is that on many occasions we don't reach the recovery phase, because if politicians won't allow the recession to take place, they will often go straight from phase 3 back to phase 1 and try and create a boom to mitigate and to mask the effects of the recession. Or if we put these kind of 4 phases back in terms of the sobering up drunk, phase 1 is the initial drunkenness, the euphoria. Phase 2 is when you throw up. Phase 3 is your hangover. Phase 4 is the recovery. As Mises said, true, governments can reduce the rate of interest in the short run. They can issue additional paper money. They can open the way to credit expansion by the banks. They can thus create an artificial boom and the appearance of prosperity. But such a boom is bound to collapse soon or late and to bring about a depression. By way of conclusion, we could talk about whether or not this is destined to happen again. And this brings us to the political economy of public finance. If the public aren't willing or able to fund their desired public spending through taxation, it will inevitably lead to a monetization of debt and the boom-bust cycle. There are 3 main sources of government finance: tax, debt, inflation. If the public don't want governments to raise funding through taxation, debt is the next alternative. If the government raises funding through debt, there is an inevitable tendency to try and pay that off through inflation. Now, debt isn't bad per se. If we think of savings as being the reward for past labour, then all that debt is when we bring forward the expected rewards for future labour. You can either pay for something using the value of the work you've already done, or you can pay for something through the value of the work that you expect to do. Think about student debt. Student debt isn't necessarily good or bad. It's riskier, but it depends on several things, whether or not it's a good idea. It depends on what you're spending it on. If you use debt to fund investment, for example, education, then you anticipate that the future value of your human capital will exceed the interest costs of the loans. Indeed, it's usually worth getting into debt as a student because your future earnings will be sufficient to pay off the interest charges. It's a good deal. The assumption, though, I'm making is that your degree is in something socially useful, such as economics. If it's not a socially useful degree, then getting into debt may not be a good idea. But if we're not borrowing money in order to pay for investment, if we're borrowing money in order to pay for consumption, then we're engaged in capital consumption, and this can be problematic. For example, if you're using your credit card to go on holiday or buy a flat screen TV, then you still need to pay that at some point, and there's no there's nothing that you've done to improve your future earning power. The issue really comes down to how accurate your expectations are about future income streams. Being able to move money from the future into the present is a very valuable thing and a very important service that we have, but it depends on your ability to mediate those time periods. The problem occurs if we overestimate our future incomes and thus borrow against future income that doesn't materialise. Austrians would argue that this is what happened in the build-up to the 2007-2008 crisis. People were borrowing against future incomes that didn't materialise. In other words, we weren't as rich as we thought we were. Now, basic public choice theory tells us why politicians are unlikely to get these long-term trade-offs right for the economy as a whole. It's because they're more likely to spend money on short-term policies that please interest groups, not on policies that generate long-term growth and increases in income. They're also more likely to overestimate the future growth of the economy, or at least not worry about the consequences of overestimating that future growth, because their time horizons are shorter. This brings us to the old adage about why we see permanent budget deficits. Given that we expect permanent budget deficits, this will inevitably lead to a large public debt burden. If we have a public debt burden, then we have a temptation to reduce that debt burden through inflation, i.e. the monetization of debt, and this is what creates an artificial boom. As we've seen, the boom necessarily leads to a bust, and this is what constitutes a recession. We have budget deficit leading to monetization of debt, leading to recession. The solution is quite simple. The solution to permanent budget deficits is to have balanced budgets. The solution to monetization is to have sound money. But inevitably, whenever we see financial crises, we tend to see this pattern at play, where the cause is inflation, but the root cause of the inflation is fiscal profligacy.